Hi everyone, welcome to another episode of In Conversation, my advisor coach. Today in conversation, I'm very happy to welcome our guest, Mr. Mayur Patel, President, Fund Manager Equity 361 Asset. How are you, Mayur?
Excellent, Suren. Thanks for the opportunity.
Our pleasure always. I don't think we could have had this podcast at a better time when markets have been extremely volatile.
Abs- Absolutely.
Thank you so much for taking our time while the trading session is on at the moment. So, Mayur, 361 Flexi Cap Fund, that's the fund which we are talking about today. It covers its 3 years, of period since inception on the 4th of June 2026. Correct. So, first of all, congratulations for the successful 3 years journey.
Thank you. Thanks, Suren.
So, I'll have to read this out. So I was going through some performance numbers, and I'm specifically talking about the regular plans for the 361 Flexi Cap. Uh, 6th of July 2023 to 4th of August of 2026 on a daily rolling return basis for 3 year period, the average return for the scheme has been 16.10% versus the FlexiCap average as a category of 12.24%. So that's almost we can say rounded off to 4% higher than the average FlexiCap as a category. And if you further to dig down, then the fund has also given a return of 100% between a bucket of 15 to 20% throughout in the same period on a rolling return basis. Now, how did this happen? If you could just take our viewers about, how this fund you manage and what's your thought, what's your investment style on the FlexiCap fund.
Sure. Uh, Hello, everyone. Suren did the introduction. So instead of a jump to this question, and it was a good outcome to have the first 3 years on this note. I would say the fund benefited from our bottom-up selection approach without bias towards any specific market cap segment. If you see the large cap component, if you see over last 3 years' time, the large cap segment in our portfolio has gone down to as low as 38%, and it went up to as high as 62%, purely based on our bottom-up risk-reward analysis. So, this is what a FlexiCap fund is supposed to do, and that's what we are trying to be true to the label. In terms of where the alpha came from, our bullish stance on India's manufacturing growth story played out really well through our bottom-up picks across electronics manufacturing, power T&D, renewables manufacturing, and defense. Uh, so the most of the active returns have come from the stock selection rather than taking any extreme calls on sector allocation. So going forward also, I would say the FlexiCap fund would be driven by our bottom-up approach, our market cap agnostic approach, our blend philosophy, which enables us to invest across growth, value, and defensive stocks, not getting restricted to one factor. That's what would continue to drive our FlexiCap strategy going forward.
Sure. So how many stocks you would hold in a 361 FlexiCap fund?
So without underwriting anything, we typically, this FlexiCap fund, we have been keeping around 40 to 50 stocks. That's a
40.
kind of, yeah,
Sure, sure. And I think peer average is almost about 65 to 70 stocks in the flexi cap sort of a
yeah,
strategy.
yeah.
Right, right. So when we were going through the regular fund performance again of 361, what I noticed that the upmarket capture ratio in the similar period is at 111%, and the down market capture ratio is at 93%, right? For our viewers, up market, down market means that how well the fund is participating when the markets are going up, and how well the fund is defending when the markets are going down in terms of the participation. And if you look at the overall capture ratio is at about 1.19%. Uh, so what would you like to say on the up market and the down market and the overall capture ratio? Because that's very, very critical because we often say that it's great if the fund moves in tandem or much more sharper when the market moves up, but it's also very important that how much it participates on the downside as well. So how do you kind of manage that, restrict that, or take care of that?
So, so this is definitely a good outcome, and I would say there are two factors which helped us in achieving this. Number one is our market cap agnostic approach. Number two is our blend philosophy. So let me just cover the first factor. At different points in time, certain market cap segments become expensive and some get attractively priced. So if you're bound to a specific market cap segment, then it would be really difficult to achieve this kind of favorable outcome in both up and down market. Right? So a market cap agnostic approach helps us to invest in segments where the risk reward, our risk rewards are attractive, and rotate out of segments where either valuations are very high, or growth is deteriorating and overall risk reward is not making strong case for alpha generation. So that's the first factor, where while you remain having a buy and hold kind of strategy, but don't shy away from rotating capital out of unattractive
Hmm.
market cap segments,
Hmm.
right? So if you see in, you know, 2 years back, somewhere around September, October 2024, small and mid caps became really expensive. But if you're bound to these segments only, then there would be a period when you would go through a much sharper drawdown than what market is witnessing. Right.
Sure.
The same thing is applicable to sectors and factors. Right. So if you're bound to a specific or few sectors, or if your investment style is uh, is isolated in a one particular factor, say growth investing or value investing, then there would be times when it would be difficult to beat the market either on the upside or on the downside, um, because that factor is completely out of flavor, right? So that brings me to our second factor, which is our blend investment philosophy,
Hmm.
which basically we follow a framework called SCDV framework. That's secular, cyclical, defensives, and value traps. This enables us to focus more on bottom-up selection and invest, always have a mix of secular growth stocks, cyclical value stocks, quality defensive stocks, and have a constrained exposure in the value trap segment. So that takes care of that risk of being isolated in one factor and that factor going out of flavor. Right.
Sure.
So that SCDV framework, has kept our focus more on bottom-up idea generation and building conviction around it, and not getting bothered about which part of the market will perform. Right. So these are the two factors which helped us, Suren.
Sure. Let me ask you a very direct question. Is that a lot of you know parameters, investors, mutual fund distributors, advisors, and the industry as such speak about what's your churn ratio, what's your churn ratio of the portfolio, iska churn ratio is zyada hai, iska kam hai, etc. But ultimately, at the end of the day, everything is factored in, correct? When an investor is looking from an NAV to NAV, how much returns has he realized or accumulated on the performance side. So, would you be worried really in case there is something where you really want to exit and you believe that the market is giving you a lot of opportunity, that okay, I need to play with the market's momentum at this point of time so that I kind of provide a higher alpha in the portfolio? Or would you be worried about the, okay, how's my churn ratio going on, etc., etc.? So what's the how agile this portfolio can be?
Oh, a very pertinent question, Suren. I would say the portfolio turnover ratio or the churn ratio is more like an outcome. It should not be driving your investment decision. If you look at the portfolio turnover ratio of our Flexi Cap fund, which has a vintage of 3 years, or even our Focus fund, which has a vintage of more than 10 years, we would fall into one of the lowest portfolio turnover ratios, right? But if you do a granular analysis, there are times when the portfolio turnover ratio has moved up
Mm-hmm.
from a long-term trend of around 30-35%, sharply
Mm-hmm.
to 50-55% also. Then again, it has come down. So our long-term, the portfolio turnover ratio is pretty low, I would say. But there are times when it requires, when we see compelling alpha opportunities, we don't shy away from, booking profits in names which have entered an uncomfortable valuation zone, or even mistakes, to do course correction is very important. And that's what is
Right.
one of my biggest learning over last, 8 years, 10 years time frame, that the biggest mistakes, at least what I have seen, analyzing the detractors in the portfolio, uh, mistakes are not largely coming from missing out on large opportunities.
Yes.
I would say the bigger mistakes have been holding on to our losers.
Mm-hmm.
Investment thesis, is not going as per your original thought, and you get trapped into that stock is out of, you're out of your cost, and you want to hold on to it. It's a good quality. There could be many other factors, right? So I would say, over a period of time, I've learned and I have created certain frameworks to exit, and where investment thesis is not going as per the original thought, and based on our ongoing research, beyond a particular time and beyond a particular threshold, I take a exit call, even if for the timing the portfolio turnover shoots up.
Right.
So that's what is my thought, that I won't be perturbed by short-term rise in portfolio turnovers if it is in the best interest of the unit holders.
Absolutely correct. And I completely echo your thoughts because that's what a flexi cap fund is all about. Someone who really doesn't want to, go with a large cap or a mid cap or small cap, just simply says, okay, I'm giving it to a professional fund manager, allow him to manage between the market caps as well as the sectors, etc. And at the end of the day, he's looking at what kind of risk adjusted performances are being delivered out. Absolutely. FlexiCap fund as a category have always been the market's favorite, right? But of course, in the past few years, we have seen some of the categories like the small caps and the mid caps and the thematics also catching up, right? So what do you want to say particularly about a flexi cap as a strategy, as a must to have in every client's portfolio? What's your thought on that?
Oh, absolutely. FlexiCap has become a popular category, and there are few reasons, very strong reasons for that. First, unconstrained flexibility in a market which is genuinely volatile. So investors want a fund manager to take right decisions, responding to changing economic conditions or changing market conditions, and manage risk better rather than getting locked into a specific or a fixed segment. Two, investors, there are a set of investors who want a one-stop solution to have an exposure across different market caps. They want the fund manager to take calls and dynamically allocate capital across market caps based on right risk rewards, instead of assembling and rebalancing three separate funds themselves, right?
Absolutely.
And last but not the least, this category has built a good track record, sailing through different stress events, and build that trust for it to become a core portfolio product rather than a satellite bet.
Sure, absolutely. How would you compare this category to a multi-cap category?
No, so again, it comes to the biggest fascinating factor about this category is the name itself, Flexi,
Hmm.
right?
Hmm.
It's a flexi cap. It gives flexibility. That's what I think you can extract. The investors are giving money to a fund manager.
Right.
And obviously, the intention is to extract the maximum out of that person's skill set to generate alpha. And you can do that if you give 100% flexibility to that person. right?
Hmm. Hmm.
In a multi-cap fund, there are certain nuances about
Hmm.
investing X amount in large cap,
Throughout, yes.
Y amount in mid cap, Z amount in small cap, right? At some point of time, if say large cap becomes X growth, there is really low growth and valuations are not compelling, for example, right? Why to have exposure there? Or like in September, October 2024, small and mid caps were in really, uh, a super expensive valuation zone, right? Why somebody would be forced to invest a large part in small and mid caps, which would be there in multi-cap
Yes,
strategy.
absolutely.
A flexi cap fund can take drastic calls if it is run truly like a flexi cap and reduce exposure significantly in segments where risk rewards have become unattractive.
Absolutely. I completely echo your thoughts because in a multi-cap, the weight is 25, 25, 25.
Yes.
Sometimes the portfolio, and of course, as an outcome of that, the investor gets punished of remaining in a sector specifically when the sector is really underperforming. And that's the advantage which Flexi gives over and above a category, not at the cost of any of the fund over the other category. But of course, that's also an important category to have in the portfolio as an asset allocation. But of course, Flexi gives that far more flexibility on that as well. Correct. You did mention about your investment management framework. Could you elaborate that a bit more? How many stocks are there in coverage, through your entire research and analyst team?
Sure. So we have including the research team and the fund managers, we have a 17-member investment team based
Hmm.
out of Mumbai. Covering the research side, we have an in-depth research coverage on more than 350 stocks. Right. So that's more on the coverage side. In terms of our investment processes, uh, if I will, if I may cover, the first part is our framework. That's our investment philosophy or the investment framework. We call it as a SCDV framework,
Hmm. Hmm.
which in layman's term enables us to invest across growth, value, and defensive stocks.
Hmm.
The portfolio always have a mix of these three factors, right? And we can try to be intelligent in terms of allocating more capital in quadrants which are offering good risk reward, but
Of course.
we would always have a mix. So in whether it's a growth market like 2013 to 2020, and quality and growth was outperforming, value was underperforming. Our schemes did a reasonable job in that market. Some of the schemes did a really good, delivered good performance. 2020 to 2024 was a period of value outperforming massively, right? And the portfolios were rightly positioned even in that environment. And now quality is coming back, right? So this framework helps us to always have a mix of secular growth stocks, cyclical stocks, quality defensives, and have a constrained exposure in
Hmm.
market traps.
Hmm.
So that's, I would say the most critical part of our investment process. If I can cover some of the other processes, is like I mentioned about bottom-up stock selection. So we give very high emphasis to bottom-up high conviction bets,
Hmm.
whether it's a growth stock or a value stock or a quality stock, right? So that's the one part. The second part is our weekly sessions where the entire team sits together. It's a great platform to have an open debate
Hmm.
on any investment idea, right? So it's a best way to extract highest conviction from the guys participating, right? Another interesting thing is we have automated quite a few tools like forensic analysis, framework, fraud detection framework, like Benford's law. Some of these tools have been automated, and before proceeding on any investment idea and spending more time on on-ground research, we run through these tools, and if there are any red flags, the idea gets dropped upfront.
Sure, sure.
More time is invested. And last but not the least, which is very close to my heart, is the touch and feel of the business. As we progress on an idea and start executing it, would love to have on-ground research, visiting the facilities of the company, having the touch and feel of the business. And that's what helps to, increase conviction.
Sure, sure, sure. Excellent. Let me ask you another difficult question. I'm sorry about that. And let me pick your brains. What, of course, we all know in the long term, 5 years, 10 years, how the markets will behave and, the long story, which we all know. But what's your thought in the immediate terms in the next 2 to 3 years on the markets, given all the noises around us? What's your thought on that?
No, I'm quite bullish on the market at this point of time. I'm calling out two things.
Huh.
First, uh, foreign inflows in our equity markets would pick up significantly as
Hmm,
rupee stabilizes and actually gains strength. Second is the corporate earning cycle,
hmm,
especially in the broader 500 companies universe, will witness an upgrade cycle.
hmm,
So, if you see in the near term, the liquidity surge coming from FCNRB
hmm,
and related initiatives is the key catalyst for the market. But as West Asia conflict ends, you would see crude settling around $70, which is
hmm.
very positive for our economy. Consumer discretionary demand, CV cycle, and private capex would pick up significantly. With Nifty trading at around 3 times price to book valuation, I think the setup is hinting towards a comprehensive rally as we, move beyond the West Asia conflict.
Sure. Tell me, well, there are a lot of people who have this thought saying that fine FCNRBs are coming in, OFCBs are coming in, as well as the ECBs, but we are kind of giving an easier exit to the FIIs withdrawing through that, correct? Do you believe that they are right?
No, I wouldn't say that anyone is giving any exit. It's a market and it's a play on risk reward. In
Hmm, hmm,
September 2024, our price to book valuation of the Nifty was above 4 times.
hmm,
It's clearly expensive, right? And we had growth slowing down. We had a gap of AI play, which was there in some of the other emerging markets, right? And the overall outlook on the currency was not very, interesting.
hmm,
So
hmm,
combination of these factors, therefore, is we're pulling money out, right? As we speak, the currency is at the bottom. Nifty valuation is down from 4.2 times to 3 times price to book, right? So for any foreigner, foreign investor, the entry point of valuation is attractive.
hmm,
Entry point of currency is also very attractive.
hmm,
Because if you look at the factors in the short term, first, this FCNRB and other initiatives is driving a massive amount of liquidity. That should support your currency.
hmm.
Second, as this war ends and crude comes down to $70, that will again create a very strong Goldilocks kind of environment
Sure.
with trade deficit coming down, much lesser pressure on rupee, and actually
And
rupee could
UP, of course,
strengthen
yes.
in the near term. So I,
Sure.
I would say it's a play on risk reward, and risk reward is now very favorable for
Yeah.
any foreign investor to pour in money into our market rather than pull it out.
But do you believe, Mayur, that we are kind of with this expensive money which we're bringing in, and the entire the shorting of the hedging of the currency being the cost being borne by the RBI currently. Don't you think that we are actually kicking the can of the problem, just a few years from here? Because this money will rotate back unless there is
Okay.
something sweeter to that. What are your thoughts on that?
No, it's whether it's RBI or central government, whether it's a monetary policy or the fiscal policy, there would always be priorities. There would always be crisis. You know, there would always be opportunities. So, currently RBI is addressing the most pressing issue.
Hmm, hmm, hmm.
because the currency is depreciating way beyond its fair value. If you look at REER, the fair value is below 90, somewhere around
Mm.
90, and
Yes,
currency we know where it is, right? So there is a pressing need to support and reverse this currency trend to some extent, and there are no free lunches, right? So RBI is obviously there is a cost to it. The hedging cost is being borne not by the banks, right, by the RBI, but it's worth the cost. So in future, definitely. So I would say there would be right time to build buffers again when we see a good time period of benign currency, benign
sure,
rupee. I think RBI will have opportunities to recoup some of these, factors.
sure. So, Mayur, through this in conversation, what message would you like to give to all the investors, mutual fund distributors, and advisors about 361 Flexi Cap Fund in particular?
Sure. So first of all, I would say FlexiCap as a category is a very interesting proposition for investors, provided that a particular fund is run purely like a flexi cap, right? So I would like to pass on that message very strongly. It's a very interesting category, and it has to be there, based on the risk reward of a particular investor. Uh, at 361, we would continue to drive this flexi cap scheme or flexi cap strategy based on our bottom-up selection approach, our market cap agnostic approach, our approach of investing across growth, value, and defensive stocks, embracing technology as much as we can. It's a journey, right? And try to have an approach of risk management, of responding significant changes in economic environment or market valuations. So that's what would continue to drive our flexi cap strategy. And yeah, these factors should help us to, work towards the best interests of the investors.
Sure. So, well, for our viewers, this is Mr. Mayur Patel, President and Fund Manager Equity with 361 Asset Management. Uh, as 361 FlexiCap, becomes a 3 years old fund. And thank you, Mayur, for taking us through the, in depth as to what 361 FlexiCap is all about. And congratulations once again for a 3 years completion and great performance, of course. And we hope this performance continues going ahead as well, and the investors really benefit. So thank you very much for taking our time, Mayur, and taking us through the insights on your 361 FlexiCap fund.
Thanks, Suren. Thanks for the time.
Always a pleasure. So for our viewers, I would just request you to please subscribe and to the button. It's very simple. You just press it for more such wonderful updates from Advisor Coach coming in. Thank you, Mayor. Thank you very much.